Inflation has edged higher in October with food and transport prices as the main drivers. Data from Statistics South Africa shows that consumer price inflation ticked up slightly last month to 7.6% from 7.5% in September. CPI came in higher than market expectations and is likely to result in yet another rate hike when the decision of the Reserve Bank's Monetary Policy Committee is made public tomorrow. Food and non-alcoholic beverages edged higher to 12.1% and 11.9% in September. The bread and cereals category continues to experience high levels of inflation, with the annual rate increasing to 19.5%. Annual meat inflation also rising to 10.5%, while hot beverages prices increased by 14% in the 12 months to October. Oils and fat products, which drove food inflation higher for many months, bucked the trend, but there is some reprieve for consumers as fuel inflation continues to decline. For more on the inflation number, we're joined by Zandile Makhoba, who is a consumer economist at Liberty. Zandile, thank you so much for your time. And I mentioned as I read, that particular story around the inflation figures that coming in higher than expectations. Would that be in line with how you're seeing things as well, that this figure was higher than you would have thought it would have been probably coming into it today?
So what we've expected going into the latter half of the year is for that inflation rate to start decelerating and really starting to see the impact of the higher interest rates starting to have an impact on that inflation trajectory. So this is a CPI inflation higher than what the market expected. And this is really going to be a notable push just in terms of what the MPC decides in tomorrow's meeting.
What was quite worryingly was that the core CPI inflation, which excludes food and non-alcoholic beverages, also a little bit higher. Does that then make it concerning that the second round effects that the Reserve Bank is often so concerned about could become entrenched?
So without the food inflation, there's obviously other core factors like your housing inflation, which are also on the rise. We're talking utilities there as well. And those are increases that have come up in a way that are not very easily controlled by monetary policy convention. So remember, the interest rate moderates money flow. And what we're seeing is that, a lot of the essential goods in the economy are seeing these sharp increases, which will not have a dramatic move just in terms of how money flows.
The other, I suppose, conversation that we've had over the past couple of weeks is whether the Reserve Bank would continue with 75 basis points instead of 100 basis points. What's your expectation going into tomorrow now that we've received this particular figure on the CPI front?
So very difficult at this moment to kind of balance the household need versus what the economy needs. We are still actually importing the inflation in many senses. So how much we actually increase the interest rate might not have as much effect as we'd like to see. But definitely because the inflation rate is higher than the Reserve Bank's own forecast for inflation at the moment, it will put them in a position to have a little bit of a higher increase than what they might have done in a different situation. So the expectation might be around a 75 basis point increase, with a few economists also thinking about a 400% or 100 basis point increase.
I suppose for the viewer watching this particular interview, and I suppose also looking forward to that interest rate decision tomorrow, what do you do from here onwards as a consumer looking at prices going up as much as they are right now?
Well, where possible, consumers can start looking at ways to reduce luxury items if the budget allows. The challenge here is that we are seeing inflation in essential goods. So things like food and fuel, which are very difficult to cut. But where possible, the idea is to then remove luxuries from the balance sheets. As interest rates increase, our debt servicing costs are also increasing. So tapping into the credit card and using credit to try and balance the household expenditure is not ideal at the moment because it will have longer term implications for the consumer. So really trying to cut down is what we want to see ourselves do.